Hey guys, in today's video, I want to help you explore 3 options for health insurance in 2026 if you're finding that the current premiums in the marketplace are simply unaffordable, but you don't qualify for Medicaid. If you're new here, my name is Shamy. I'm a healthcare finance consultant, and this channel is all about helping you understand your health insurance to save money. So if that's something you're interested in, please subscribe down below. I've included timestamps in this video so you can jump straight into the 3 strategies to help you lower your healthcare premiums in 2026. But if you'd like to learn a little bit more about what is happening and how we got here, then stick around. By now, you've most likely heard that health insurance premiums are expected to increase next year if Congress doesn't act to extend current financial help called enhanced premium tax credits. These enhanced premium tax credits were introduced in 2021 and made marketplace plans more affordable for many individuals and families. However, they're set to expire by the end of 2025. Now, before 2021, the rules were stricter and you could only qualify for premium tax credits if your income was between 100 and 400% of the federal poverty level. But in 2021, enhanced premium tax credits were introduced, which changed the rules in 2 important ways. First, if you were already eligible for premium tax credits, then enhanced premium tax credits increased the amount of help you received, and this lowered monthly premiums even more, and in some cases, people paid $0 each month, especially those earning between 100 and 150% of the federal poverty level. Now, the second major change that occurred was that people earning more than 400% of the federal poverty level were finally able to qualify for financial help as long as the cost of the silver plan was more than 8.5% of their annual household income. This is why the expiration of these enhanced premium tax credits matters so much, because if they're not renewed next year, marketplace premiums are expected to more than double. And for people making more than 400% of the federal poverty level, which is $62,600 for an individual in 2026, they'll lose financial assistance to help with premiums and will be stuck paying them in full. And let's be honest, $62,000 is not a lot of money in 2025, given the cost of living crisis impacting everything from grocery prices to housing costs, and given that some people are saddled with student loan debt. To be clear, there will still be premium tax credits in 2026, but enhanced premium tax credits may disappear if they're not extended by Congress. Open enrollment for marketplace plans starting January 1st ended December 15th, but is still open until January 15th to change your plan or enroll in coverage starting February 1st. And in this video, I'll walk you through 3 options to consider if you can't afford your marketplace health insurance, but you don't qualify for Medicaid, and explain the pros and cons of each option to help you decide what makes sense for you and your family. Now, before we continue, I want to share a quick reminder that this video is for educational and informational purposes only, and it is not a substitute for advice from an insurance agent, broker, patient navigator, patient advocate, or any other qualified health insurance professional. Let's get into it. The first option is mostly applicable to people who previously had platinum or gold plans, but find that those premiums are simply unaffordable in 2026. In this case, choosing a plan with a lower metal tier, such as silver or bronze plans, can help make those premiums more affordable since they are lower than gold and platinum plans, but do come with higher out-of-pocket costs, such as a higher deductible, higher coinsurance and copays, and higher out-of-pocket maximums. Silver plans tend to have higher premiums but lower out-of-pocket costs when compared to bronze plans. It's also important to know that the quality of care does not change between metal tier plans, and all marketplace plans cover the same 10 essential health benefits, such as hospitalizations, prescription drugs, and maternity care, among others. But what does change is how much you pay up front in your premium versus over time and out-of-pocket expenses. But you want to make sure that even as you're considering a lower tier plan, you're choosing the plan with the overall lower healthcare costs for you based on your healthcare needs. Now let me explain this through an analogy and a story time. When I was a freshman in college, I was buying new clothes for the spring-summer with my own money through a part-time campus job, so I was really on a budget. I went to a fast fashion store whose name shall remain anonymous, which was the store to buy clothes at the time that were cute, trendy, and affordable. Now, I spent about $200 and I felt really smart because I thought I found this life hack to buying clothes for 6 months at a really cheap price. But when I got home, wore the clothes, and looked at the care instructions, I realized that a lot of them needed to be dry cleaned, including this one dress that I bought for less than $20 that I planned on wearing on my 19th birthday and hope to wear all throughout my 4 college years. But I was not about to pay more to dry clean it than to buy it, so I barely wore it. But the total cost of that wardrobe was the sticker price plus the cost of dry cleaning. So in retrospect, what I should have done was gone to a department store and bought a more expensive dress, which I would have had to pay more for up front, but I would have worn more because that's something I could wash at home with the detergent I already had. And so you're probably thinking, Shamy, what does your fashion fail have to do with healthcare? Well, the connection is that it's important to consider the full price of a purchase and not just the sticker price. And in healthcare, that means considering both the premium costs and the out-of-pocket costs, because that lower premium plan might actually cost more over the course of a year than a higher premium plan if you use the healthcare system a lot, but maybe not. And to figure this out, you can use a healthcare cost estimator tool like the one at fairhealthconsumer.org, which is not sponsoring this video, to compare plans based on your usage. And if you want help on how to do this step by step, check out my video on how to estimate healthcare costs where I walk you through that. So who might downgrading metal tiers be best for? Well, in general, higher deductible plans tend to work better for people who are younger, healthier, or do not use medical care very often, because this can help you avoid paying a lot each month in premium while still having coverage in case something happens. But if you're older, have chronic conditions, or see doctors often, you should be careful when downgrading tiers, because while you'll save on the monthly premium, you could end up paying more overall on your healthcare when your out-of-pocket expenses increase. For example, if you're moving from a platinum or gold plan and you expect to receive medical care regularly, a silver plan may be a better choice for you than a bronze plan because it usually has a lower deductible to decrease your out-of-pocket expenses. And if your income is between 100 and 200% of the federal poverty level, you may also qualify for cost-sharing reductions to lower your out-of-pocket costs, such as your deductible and out-of-pocket maximum. This extra help is only available with silver plans, so if you qualify for these reductions and you're deciding between a silver and a bronze plan, you'll want to look into whether buying a silver plan could actually save you more money than a bronze plan. Now, if you usually receive very little medical care and mostly want protection for very high medical bills if you get really sick or injured, a bronze plan could make sense because while they do have the highest deductibles, they also have the lowest premiums. It's also important to note that starting in 2026, bronze plans are also considered high deductible health plans, which means they'll be eligible for a health savings account or HSA. And an HSA is a great financial tool because they are triple tax advantage, since you can contribute money tax-free, invest it tax-free, and withdraw it tax-free for healthcare costs. So the amount you save in medical expenses with an HSA goes a little further because your dollars are not taxed. At the end of the day, if you can't afford your current coverage in 2026, a lower tier plan with a higher deductible can still protect you against medical costs you couldn't afford otherwise. The second option to consider is pairing a catastrophic plan with a direct primary care membership. A catastrophic plan is designed for worst-case scenarios like getting seriously sick or injured, and compared to bronze plans and other metal tiers, catastrophic plans have the highest deductibles, meaning your insurance usually won't start paying until you have a major or catastrophic medical event, hence its name. Catastrophic plans cover at least 3 primary care visits while you're meeting your deductible, and cover preventative services at no cost. Like other ACA plans, they cover the 10 essential health benefits mentioned earlier, and similar to bronze plans, catastrophic plans will be HSA eligible next year. Because of its high deductible, a catastrophic plan on its own is not affordable for most people who need regular medical care, especially those with chronic needs or high healthcare usage. And this is where pairing a catastrophic plan with direct primary care may make sense for you. Direct primary care, or DPC, is a model where you pay a primary care doctor directly for primary care services through a monthly membership fee and do not pay extra for covered services at the time of visit. This is not health insurance, and there is no middleman between you and your doctor for payments of covered services. The services included in your membership vary by practices, but they may include things like routine screenings, lab tests, medication checkup, sick visits, and consultations. The average cost is about $50 to $100 per member per month for these services, and things that might not be included in your membership are things like prescription drugs or imaging, which you'll pay an additional fee for at the time of service. So what are the pros and cons of this combination, and is it right for you? The pros are lower monthly premiums that come with catastrophic plans, while having coverage for things like hospitalization, emergency services, and other services not included in a DPC. DPCs also provide an affordable, simple, and predictable membership costs and come with benefits such as same-day and next-day visits, more time spent with your doctor during your appointments, telehealth options, and around-the-clock access to your doctor. However, DPC practices don't include specialist care, and you'll have to manage two separate monthly payments for the catastrophic plan premium and the DPC membership costs. There are also no ACA subsidies for catastrophic plans compared to middle tier plans. So if you qualify for premium tax credits, you'll want to compare plans to see whether or not a silver or bronze plan is more affordable or a better option for you. Eligibility for catastrophic plans is also limited to people under 30, those over 30 who don't qualify for marketplace savings, and others who qualify for financial hardship. Overall, this combination works better for people who are generally healthy, mainly need primary care, and can handle a high deductible in case of an emergency. But you should think twice about it if you have chronic conditions requiring specialist care, expect surgeries, pregnancies, ongoing treatment, or any other serious but non-catastrophic medical care with a large bill before insurance kicks in. If you're interested in DPCs, I'll drop a link in the description to DPC Directories so you can find one near you. Option number 3, if you can't afford your health insurance, are short-term medical plans, which are meant to fill gaps between long-term plans. Initial terms are usually up to 3 months, with coverage lasting up to 3 years with renewals in certain states. They're sold in 36 states, more on that later. And the benefit here is that these plans usually offer some coverage for things like doctor's visits, urgent care visits, and emergency services. Another pro is that many different plan designs exist depending on your insurance company, and you can cancel coverage whenever you'd like without penalty. Now, the biggest con of these plans is part of the reason why they're banned outright in 14 states or in practice. They're often advertised as being more affordable than ACA plans since they tend to have lower premiums, but that's because they're usually less comprehensive than ACA plans. See, short-term medical plans don't have to follow the rules of the ACA and meet its minimum coverage standards, including the 10 essential health benefits we discussed earlier. They also don't have to cover pre-existing conditions like ACA plans do, meaning some short-term plans will require you to get a health screening and can decline you care based on it. If you go down this route, please understand what you're signing up for and carefully read the limitations and exclusions before buying anything. But since this isn't a forever plan, it can be better than nothing while you're trying to figure out which long-term coverage is affordable for you. I hope you learned that you do have some options available to you if you find that your ACA premiums in 2026 are unmanageable. And it's still 2025, so hopefully Congress acts to extend the enhanced premium tax credits for at least another year, so you won't even need the information in this video. Thank you so much, and I'll see you in the next one.